Hi, welcome to the cost volume profit analysis lecture. You did cost volume profit analysis or CVP last year in second year, where you mostly did break-even calculations. But CVP is actually any analysis that relates to the variables that make up profit. What are those variables? The volume or the number of units, selling price per unit, variable cost per unit, and fixed cost. So they make up profit. And CVP uses this or analyze these variables and how they will change the profit if any of the variables change upwards or downwards. So in third year, we're going to focus on how CVP is applied to managing risk. So once you've calculated the break even, what does that break even tell you? And then we're going to look at more technical considerations and more complicated CVP calculations. So we're going to integrate it with other topics. And lastly, we're going to also look at sensitivity analysis. Okay, so the module is organized as follows. First, we're going to look at the basic calculation. So basically a recap of your second year. Then we're going to do a recap of cost behavior, which is very important. And cost behavior can be integrated with any topic. And then lastly, we're going to look at sensitivity analysis, where we integrate CVP with other topics like ROI, cash flow, decision making, and so forth. Okay, so the purpose of CVP is not just to calculate the break even, but to use that calculation in order to manage your risk. So what does that mean? You start a business, for instance, and you have your fixed costs, your rental, your salaries, and so forth, and you know what your variable costs are, and you calculate the break even as 10,000 units per month. Let's say it's bicycles. So you need to sell 10,000 bicycles per month in order to break even. And that's great. So what? Well, then you have to ask yourself, is that realistic? If you need to sell 10,000 bicycles a month, you have to sell, well, roughly 300 a day. So who are you going to sell it to? Is that realistic? So if it's not, then you can't start a business. Or you have to change your variables in order to make the calculation make sense. So what do I mean by that? So if what influences this break even of 10,000 bicycles? It's our fixed costs, our variable cost per unit, and our selling price. So if we increase the selling price, then our break even will come down. So it'll be more realistic. If we lower our fixed cost and maybe even lower our variable cost as well, our break even will be even lower. And then it might turn out that we only need to sell 2,000 bicycles a month, which is still a lot, 60 a day roughly or whatever, but it's more realistic. And you can also compare the break even to competitors. You can integrate it into your marketing strategy because now you know how much you need to sell before you break even or start making a profit. Then, if you have an established business and you're not making profits or you're not making enough profit or you feel that you can make more, you can do CVP analysis in order to see which variables you need to change in order to start making that profit that you want. And also, CVP can be used to protect investments against movements in variables. So, capital budgeting, for instance, if you have a project and you have a net present value, you can calculate by how much can the variables move, like exchange rate, before you have a negative net present value. And some areas for integration is cost behavior, relevant costing, transfer pricing, capital budgeting, and discount cash flow valuation. So let's start with the basic break-even calculation. You know the formula, fixed cost divided by contribution per unit, but where does that formula come from? It's fine to memorize formulas, but if you had to memorize every single formula, you might get confused. It's always best to understand it and to know where it comes from, and to be able to make it up by yourself. So let's see. This is a basic variable costing income statement. Remember, absorption costing is what we use to report. Variable costing is what we use in management accounting. So variable costing classifies costs based on whether it's variable or fixed. So basic profit calculation, sales less variable cost equals contribution, less fixed cost equals profit. So when will we break even? Break even means we make zero profit. No profit, no loss. When will we make zero profit? Well, if our contribution is enough to cover our fixed costs. So our contribution needs to be equal to fixed costs. How many units do we need to sell in order to have a contribution that equals our fixed costs? Well, if we know the contribution per unit, we can just divide the total fixed cost by that contribution per unit in order to know how many units will give us a contribution that will offset our fixed cost to result in a zero profit. So here's an example with numbers. So our sales 100,000, variable cost 40,000, contribution of 60,000. Our fixed cost is 30,000, so we do make a profit. So where will we break even? We'll break even when our contribution is 30,000 Rand. Why? Because then we'll equal our fixed cost to give us a profit of zero. So how many units do we need to sell at the current contribution in order to have a contribution of 30,000 Rand? That's easy. 30,000 Rand divided by contribution per unit, which is 60 Rand per unit, equals 500 units. So that'll give us a sales of 50,000, variable cost of 20,000, which will give us a contribution of 30,000, less our fixed costs, so profit is zero. Sometimes there's not enough information to calculate the contribution per unit. Or sometimes they might ask you to calculate the break-even sales value. So what Rand value of sales will cause you to break even? In that case, you'll have to calculate the contribution margin percentage. So that is contribution divided by sales value. And then you'll take fixed cost divided by contribution margin percentage. And that'll give you the sales break-even value. So our same example again, our contribution margin percentage is the 60,000 contribution divided by 100,000 Rand sales, which is 60%. Then fixed cost 30,000 divided by 60% is the 50,000 Rand in sales that we had previously. If you want to calculate how many units you need to sell in order to make a target profit, the calculation is similar to the break-even. So let's see. Say our target profit is 90,000 Rand. We want to know how many units do we need to sell in order to make a profit of 90,000 Rand. Remember, to calculate break-even, we need to cover our fixed costs. So if we want to make 90,000 Rand profit, which is 90,000 Rand more than our break-even, we need to cover our fixed cost of 30,000 and our profit of 90,000 with our contribution. So now our contribution needs to be 30,000 plus 90,000, which is 120,000 Rand. So how many units do you need to sell at a contribution of 60 Rand per unit? Well, it's 120,000 Rand divided by 60 Rand contribution. This is 2,000 units. Similarly, if you want to calculate the sales value that you need for the target profit, you do the same thing. We add the fixed cost of 30,000 to the target profit of 90,000 and divide it by the contribution margin percentage. That will give you the sales value that you need to reach in order to make a profit of 90,000 Rand. So margin of safety. What is that? That tells us how safe we are in terms of our current sales in relation to the break-even sales, or by how much can our current sales drop before we start making a loss. So for instance, say our break-even is 10,000 units and we're currently selling 11,000 units. Our margin of safety is that 1,000 units in excess of the break-even. and expressed as a percentage, you'll divide that 1000 by the current sales level. So in our example, 1000 divided by 11,000, so roughly 9%. So our sales can drop by 9% before we start making a loss. If our margin of safety is big, say we're currently selling 20,000 units and our break even is still 10,000, then our margin of safety is a full 10,000 units. So 10,000 divided by our current sales of 20,000 means our current sales can drop by 50%, or it can halve before we start making a loss. The margin of safety gives you some indication of the risk involved in the business. Related to margin of safety is the degree of operating leverage. That is a number that tells us by how much our profit will increase for a certain increase in sales. And it's calculated by taking the contribution margin or contribution divided by net profit. So if contribution divided by net profit gives us a degree of operating leverage of 1.5, then it means, well, if our sales increases by, say, 50%, our profit will increase by 50% multiplied by the degree of operating leverage, which is 1.5. So our profit will increase by 75%. So let's look at an example. Here's our income statement again. So our degree of operating leverage is contribution of 60,000 divided by net operating profit of 30,000, which is 2. Therefore, if our sales increase by 100%, our profit will increase by 2 times 100%, which is 200%. So if sales goes up by 100%, it will be 200,000 Rand. Profit will increase by 200%. So what is 30,000 increased by 200%? Well, it's 90,000. Whoa, time for a loud warning. Please take time to read this. Basically, it says don't memorize these formulas, understand them. All the examples that follows can be worked out from first principles. So you must link your understanding of cost behavior, remember I said that's very important, with basic maths. Okay, let's dive into an example. Say a class of students are going on a wine tour. There's 130 students in class. The wine tasting fee at the wine farm is 80 Rand per person. That's what they charge. And the bus ride is 2,000 Rand per trip. At the moment, only 35 seem to be interested. The ticket price per person is 125 Rand. And it could change, but that's the current price. So the first question is identify the variable cost and the fixed cost respectively. Hey, well done. So the tasting fee is a variable cost per person and the bus ride is fixed. So as more students go on the wine tour, the wine tasting fee will increase by 80 Rand for each extra person. But the bus ride will stay 2,000 Rand per trip. Except if we fill the bus and we need another bus. Number 2. Calculate the net profit of the tour if only 35 students went on the tour and the ticket price was 125 Rand per student. What is the quickest way to do this? Well, quickest way would be to say the number of students, 35, times the contribution per student, less the fixed cost. Or you can do an income statement like this. So ticket revenue for 35 students is 4,375 at 120 Rand per student. The variable cost is 80 Rand per student, so that's 2,800 for the 35 students. Gives us a contribution of 1,575. The shortcut was to say contribution of 45 Rand per student times 35 students. And then we deduct the fixed cost to get to a net loss of 425 Rand. Okay, next. If the ticket price was set at 125 Rand per student, how many students would have to go on the tour for the tour to break even? So you can use your calculation, or you can just think logically. How many students will cause the tour to break even? Or how many students do we need to cover the bus ride, the fixed cost of 2,000 Rand per trip? Well, how much does each student contribute? It's the contribution per unit, 125 Rand less the 80 Rand per person. So how many students do we need to contribute 45 Rand in order to cover the 2,000 Rand per? That's right. 2,000 divided by 45 is 44.4 students. Now we can't take zero point 0.4 of a student on the trip, so we'll have to round it up to 45 students before we break even. There at the bottom we have the contribution, or the break-even calculation. Fixed cost divided by contribution per student equals 44.4, round up to 45. Then there's the incremental approach. So currently we're making a loss of 425 Rand. So how much does that loss need to change in order to break even? Well, it needs to change by 425 Rand. It needs to disappear. So how many students contributing 45 Rand each we need in order to have that loss disappear? So the loss 425 divided by 45 Rand gives us 9.44 students. If we round that up to the next full student, 10, then we know we need 10 additional students to break even. Currently we have 35. That gave us the loss of 425. So if we add 10 students, we have 45. And that's the same as the break even we had on the previous page. The next part of this question could have said, what is the total amount that needs to be collected from students in order to cover the cost or to break even? So that's a sales value break even. So can you remember what we do there? Yes, it's the fixed cost divided by contribution margin percentage. So the contribution margin percentage is the contribution of 45 Rand divided by the ticket price of 125. And if we divide that into the 2,000 Rand fixed cost, we get 5,556. So that we can test it. Say our break-even number of students was 44.4 times 125. So we need 5,556 collected from the 35 students before we break even. Okay, next up, what if 35 students go on the tour? What would the ticket price have to be in order for the cost of the tour to be covered? So what is the break-even selling price or ticket price? So there's different ways to do it. One way would be to say, well, 2,000 is needed from 35 students for the fixed cost. So that is 57 Rand 14 just to cover the bus, and then additional 80 Rand tasting fee per student. So in total, each student needs to contribute 137 Rand and 14 cents for both fixed and variable costs. So that is the break-even selling price. Another way would have been to say, what is the total variable cost? So that would have been the 35 students times 80 Rand tasting fee. And then you add that to the 2,000 fixed cost. And if you divide that by the 35 students, you'll also have the same ticket price of 137.40. Okay, another variation could be, what is the break-even variable cost? Remember I said if you want to increase your profits, there's only so many variables you can change. You can have more students go on the trip, you can increase the ticket price, or you can lower the fixed cost or the variable cost per person. So in this case, let's assume 35 students can go on the tour, and they can't pay more than 125. So we're limited by the number of students and the ticket price. Also, we can't lower the bus ride. So the only thing we can do is lower the fee that the wine tasting or the wine farm charges. So the break-even variable cost. How do we calculate? So in order to break even, we need to cover the fixed cost of 2,000 Rand from the 35 students. So that's our 57 Rand 14 needed per student. But then we only get 125 Rand from each student. So if the ticket price is 125 and we take 57.14 for the fixed cost, what is left is available to cover the variable cost. So 67 Rand 86 is the maximum that the wine farms can charge for us to break even. Now it gets interesting. So what if the ticket price is 110 Rand per student, and as a result more students are interested because it's cheaper? The 2,000 Rand payable to the bus company is for a 60-seater bus, irrespective of whether 60 students or less will go on the tour. If there are more than 60 students interested in going on the tour, the bus company has agreed to provide a second 40-seater bus at 1,000 Rand, irrespective of whether they will be able to fill the second bus or not. How many students need to go on the tour to break even? Can you see the bus now is not a fixed cost anymore, it's a step fixed cost. So it's fixed for the first 60 students to 2,000 Rand, and thereafter for the next 40 students, it's fixed at another 1,000 Rand. So how do we calculate the break even now? So step 1, assume only one bus is needed. So the fixed cost for one bus is 2,000 Rand, divided by contribution per unit, which is 110, the ticket price, less variable cost of 80, that gives us 66.7 or 67 full students. Was this bus big enough? At step 2, no it's not. It's more than 60. So we need the second bus. So now we recalculate the break-even units using the next step up in the fixed cost. So now the total fixed cost is the two buses, 2,000 plus 1,000 Rand, so 3,000 in total, divided by the contribution per unit per student, 30 Rand, gives us 100 students must go on the tour. Will 100 students fit into the two buses? One can take 60, one can take 40. Yes, they can. So the break even is 100 students. Okay, once again, let's assume 35 students go on the tour and the cost per person is 80 Rand. So what if they price the tickets in US dollars and it's priced at $16 per person? What would the Rand dollar exchange rate need to be in order to break even? But before you think of a formula, think logically. What do you want to calculate? You want to know what Rand dollar exchange rate will cause our ticket sales to cover our full costs in order to make a zero profit. What cost do we need to cover? We need to cover the bus ride of 2,000 Rand, the fixed cost, as well as the variable cost of 80 Rand per person times 35 students, so 2,800 Rand. So in total we need to cover 4,800 Rand with our 35 students ticket fares. Now we know we are receiving $16 for each student. That equates to 560 US dollars, and that needs to cover our 4,800 rands in total costs. So if you divide the costs by the dollar amount, you get the exchange rate that we need in order to cover our total cost, or in order to break even. So now the next question is, if the rand strengthens, would that be good or bad for our break even? Yes, it would be bad, because if the rand strengthens, so let's say it goes down to 8 Rand per US dollar, we will not have enough to cover our costs, and we won't break even. If the rand deteriorates, on the other hand, we'll get more rands for our US dollars, more rand for our tickets, so we'll have more to cover our fixed costs and our variable costs. So we'll make a bigger profit. Okay, so now it gets interesting. So the reason why the other half of the class does not want to go on the trip is because they don't drink wine, but they do eat cheese. So the class decides on a joint wine and cheese tasting tour. The price per cheese ticket is 125 Rand per student, to be fair, so the same as the wine, but the farms only charge 65 Rand per ticket, not 80 Rand as for the wine. Then an initial survey of the class indicates that twice as many students will be interested in the cheese tasting than the wine tasting. You are asked to calculate the break-even number of each ticket, so cheese and wine, that needs to be sold in order to break even. So this is a multi-product scenario with a product mix. Now, one thing that's important with multiple products is that you have to assume that there's a fixed product mix. In this case, 2 cheese for every wine tasting, so 2 to 1. So how do we calculate this? Now there's 2 ways to do it. I'm first going to do the weighted average contribution margin and then the batch method. So the formula, remember, for break-even is fixed cost divided by contribution per unit, but now we have 2 different products. So it's simple. We just calculate the weighted average contribution per unit. Because it's in a fixed ratio, 2 to 1, we can do that. And then we divide the fixed cost by that weighted average contribution. So what is the weighted average contribution? The contribution for wine is 45 Rand. So the wine sales 125 per ticket, less the variable cost of 80 Rand. And for the cheese, it's the selling price or ticket price of 125 less the variable cost of 65. So that's a contribution of 60 Rand. So 45 and 60 Rand. To calculate the weighted average, we multiply it by 1/3 for the wine and 2/3 for the cheese. Where does the 1/3 come from? Well, for every 1 wine sales ticket, there's 2 cheese tickets sold. So 1 out of every 3. 1 out of 3 is wine and 2 out of every 3 is cheese. So this gives us a weighted average contribution of 55 Rand per ticket, regardless of what it is. So fixed cost of 2,000, that's the bus, divided by the weighted average contribution, 55, is 36.3 units or students. To know how many of these students will go on the wine tour, we multiply by 1/3. And if we multiply it by 2/3, we get the number of students that goes on the cheese tour to break even. So in order to break even, remember, provided that the sales ratio is 2 to 1 for cheese and wine, 24.2 students need to go on the cheese tour and 12.1 on the wine tour. Now, obviously, we need to round up, and if you round up both, we'll make a profit. If you round up only one, we'll probably still break even. But that's a minor. You won't lose too many marks for that. Just remember then, if a unit can't be divided, you have to round up. Otherwise, you will not break even. 0.2 of a student is not going to pay. In the batch approach. So in this case, we'll take a batch as the smallest denominator of the product mix. In this case, 1 wine sales ticket and 1 cheese ticket, or 2 cheese tickets. Remember, it's 1 to 2. So 1 wine and 2 cheese sales will make up 1 batch. So what is the contribution per batch? Remember, the contribution for a wine sale is 45 Rand, and for cheese, 60 Rand. So 2 times 60 is 120, plus 45 is 165, so that's 165 Rand contribution per batch. Remember, a batch includes 1 wine ticket and 2 cheese tickets. So what is the break-even number of batches? It's a fixed cost per bus divided by contribution per batch, and that's 12.1 batches. And now to know how many in the batch will be wine sales, you multiply it by 1 because there's only 1 wine ticket in a batch, and you multiply it by 2 to get the number of cheese tickets, so that's 24.2. It's important to know both methods because sometimes the information is given in such a way that the batch approach is easier, and other times the weighted average contribution margin approach is easier. So make sure you understand